Hey everyone, so for today, let's talk about the latest events in the stock market. Inflation data came in much lower than predicted, which is strange, but the market isn't reacting negatively. The Nasdaq lost 3% at one point, and now it's back up at 1.8%. Before today, the SP 500 was down more than 2%, but now it's up 2%. Tesla's stock was down as much as 4% throughout the trading day, but it's presently up 2%. Now, this is Investing Path. And for today's video, let's see if we can figure out what's going on. But before that, please make sure to give this video a like, subscribe, and hit the bell button for more of our financing and personal investment content. But besides that, let's get this started. Now, one thing that we should always keep in mind is that even though retailers are losing cash and investing less on average, we continue to see daily inflows of roughly $9 million. This is despite the fact that retailers have been net buyers all year, rather than $1.2 to $10.5 billion as previously estimated by VanderTrack. The amount of money being used to buy the dip has significantly decreased in recent months. However, there are still many investors on the sidelines who are willing to buy the dip. Meanwhile, something else worth noting is that we are not observing the VIX. Capitulation levels, which you'd anticipate signify a bottom in the volatility index, were indeed reached. The VIX peaked at 85 in March of 2020, and since then it has steadily declined, as shown by the descending trend line of peaks shown above. The MOVE index, which can be thought as a bond market equivalent to the VIX, clearly shows that volatility is currently at extremely high levels, much above those observed in March of 2020. However, in the stock market, it has been difficult to reach new highs on the tunnel. St. Louis Fed chart for CPI is one location we might see this or sort of expectation, as it's only a question of how much it's going to go down. The necessary steps to reduce inflation are laid out before us. Observe this now. It's quite an interesting process. The most recent information we have on CPI is for month of September, and it shows an annual increase of 8.2%. And if we are going to go from percentages, then well, we have no choice. Let us explain this one first. Let's switch from percentages, where we almost experienced a deflation shortly after the pandemic. There has been almost no inflation, but when compared to the rest of February, March, and April, the rate of inflation jumped from 1.6% to 2.6% to 4.1% to 4.9% and so on. Inflation is slowed for a while, but then came Delta, and then came Omicron, and then came war, which is insane. Wow, those are some seriously crazy factors that could lead to inflation. Since CPI is not computed as a percentage, we may convert this graph to a nominal figure by simply taking the index value. CPI is just an accumulation over time of a base figure. If you're asking how much this basket costs per month, you are partially correct. What's intriguing is that when we swap to this figure, we can do a comparison, even setting aside percentages for the time being. Is there a target rate we must reach next year to achieve inflation parity? Even if you disregard the percentages for a second, you can see that the rate of inflation growth has slowed considerably between May and June of 2020. The Consumer Price Index barely budged from its previous rate of around 1,375 to its new level of around 1,381. The interesting thing is that the index level was 1,261 in June of 2021, and we are able to identify a rough inflection point in June of this year. I'll do the fast arithmetic for you so you can understand how this works, but if we do wind up being well by next June, that's very exceptional. It is now June of 2021, 1,261 CE, and you've jumped to 1,374 CE over here. Look at this. 1,374 minus 1,264 is the next fraction to keep an eye on. That gives you a fair idea of the 8.7% inflation rate needed if we maintain our current trajectory through June 2023. A hypothetical increase in the index reading to 1,400 due to modest growth would result in an inflation rate of just 1.2%, which is 1.4% when rounded up. As a result, the current trend of CPI flattening is very cool. In other words, this chart's main purpose is to emphasize how quickly the slope has been increasing in relation to CPI. When we look at the figures in the context of previous years, they are certain to be high. Now, one of the main difficulties or specific concerns that we have right now is that we are seeing particular segments, like rentals, medical services, and food, continue to climb month over month, and that is quite awful. This is true because, on a more global scale, the inflection of those individual parts adds up. Increasing inflation has halted significantly. There has been no precipitous decline as of yet. We have not yet reached the point of deflation, where prices are genuinely lower than they were before. However, the total rate of change indicates that deflation is occurring. But to put it simply, we think it's possible that we have two causes for this short-term upswing. The first is the elimination of short positions, and the second is the expectation that the current bout of inflation may be worse until, say, the summer of 2023. Is it not conceivable that the inflation will be far lower if we maintain the current level of activity? To that end, we believe the markets are looking ahead to quarter 3 earnings and the upcoming summer. As a matter of fact, in light of the course members' live broadcast, we went over TSMC again. Additionally, we analyzed Delta's financials, and we must tell you that the company's profits were superb. Latest earnings from the Pepsi also didn't indicate a slowdown, and neither do these. The lack of slowdown there is cause for concern that it could serve to prop up prices. But a glance at the big picture reveals that headline inflation is actually declining. It is typical for markets to set prices 6 to 12 months in advance for such items. We know it's difficult to comprehend, but in little over 9 months, by June 2023, we should have a pretty good idea of whether or not the CPI has continued to trend in a similar direction, and so we can look back at the inflection point. We anticipate a really low headline read, which we sincerely hope holds true. It would be ideal if rents fell at the same time as owners' comparable rents did, and we believe rents will fall in tandem with the property market. It should only take another 6 months or so to reach this point, and with peak rents perhaps occurring in the fall of 2022, a reduction in owners' comparable rates might occur as early as the spring of summer of 2023. The same remains true here. Despite the optimism around the recent uptick in headline CPI statistics, this does not guarantee that we have reached rock bottom. But what should we do about this? Well, our plan is straightforward. Avoid using margin, put in long hours, and keep making investments. Even if it feels like I'm throwing money into a fire pit, we'd rather do that than try to decipher all tiny fluctuations. Anyway, who knows? But these two things could be plausible reasons for a relief rally of sorts. But bear in mind that an earnings recession is probably in our future. Some companies like American Express or Tesla or Lulu, with enormous pricing power, may outperform the market. Earnings are likely to be disappointing for most companies, and that could spell more trouble for markets. But other than those things, this video has come to an end. What are your thoughts about this one? Make sure to leave your insight in the comment section below, and we'd be more than happy to join in the discussion. Thanks again for watching. This is Investing Path. Please make sure to click the like, subscribe, and bell button to stay updated for more of our future uploads. Thanks again, and we'll see you soon.